A widely expected interest rate cut at the conclusion of the Federal Reserve's policy meeting Wednesday has many wondering what impact the decision may have after one of the central bank's steepest increases for borrowing costs in history. Let's start with how it might affect housing and consumers. Michael Bailey is director of research at FBB Capital Partners.
If the Fed starts cutting rates, there's historically been a connection with mortgage rates. So as those come down, in theory, homes should become more affordable. So that may help that part of the economy. The flip side is just regular consumer products and staples. We've gone through a wave of massive inflation. That's the reason the Fed raised rates to kind of slow that down. We've done that. However, the damage has kind of been done. A lot of prices are just higher, and it's going to be less likely those prices are going to come down.
For investors, a key question may be whether the Fed will cut rates in time to avert a potential economic slowdown. George Cipollone, portfolio manager at Penn Mutual Asset Management, looked at Goldman Sachs research about how the S&P 500 performs in the first year after a rate cut.
If the economy is not in a recession, the market tends to go up roughly 10 to 15%. And if we are in a recession, the market tends to go down about 10 to 15%. So it really is two different different and binary outcomes from a potential standpoint in terms of what the stock market may do in terms of the reaction.
In terms of treasuries, they have already seen a huge rally, and some investors believe they are unlikely to run much further unless the economy experiences a recession. The problem is economists see little evidence the U.S. is currently in a recession, and we likely won't know for several more months.